able to help our clients think 360, and solve for these blind spots, where it's not just legal, not just tax, not just investment, but it's really all of these issues at once.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
Hey everyone, welcome to today's show on Wealth Strategy Secrets. We've got another awesome show for you guys today. Today we are joined by Paul Karger. Paul is the co-founder and managing director of Boston-based wealth advisory firm TwinFocus, where he manages an over $7 billion portfolio for ultra-high net worth families and individuals. Before founding TwinFocus in 2006, Paul founded the Karger Group at UBS, where he led a team that counseled global high net worth families. Day to day, Paul partners with TwinFocus key clients to advise them through a broad range of complex business, financial, and life decisions, including generational wealth transfers, extreme tax planning, investing, and more. Paul also leads the firm's direct investing efforts in private equity and real estate. Paul, welcome to the show.
Thanks, Dave. Great to be here. Thanks for having me.
Yeah, no, awesome to have you on the show, Paul. I've been really looking forward to this discussion. I knew we both grew up in the New England area and have some similar values and I think some shared experiences, and really some, powerful learning lessons that you've had through your journey that I think you can impart to the listeners to, help them get some value out of the show. So why don't we start things off? And for folks, who haven't heard of you or TwinFocus, tell us about your journey, how things started for you, how you even got into this space of wealth building.
Dave, thanks for the question. So as mentioned, and as you mentioned early on, I founded TwinFocus about 17 years ago. I was previously an investment advisor. The early days we called brokers. I started my career at Paine Webber in the late 90s. Paine Webber was subsequently bought by UBS around 2000 or 2001. And I was a young broker. I didn't have the benefit of having, a deep network of folks. So I really started my career dialing for dollars. I started with a phone book and, working nights and weekends. And, back 25 years ago, you could actually cold call people. Today, it's become much more difficult. But I built up a small book of business. And, I think like all of our careers, you kind of have these kind of lucky breaks along the way. You meet interesting individuals or folks that are able to kind of change the trajectory of your career. And I had a couple of those kind of lucky breaks early on. I'm tend to be a pretty good storyteller, and I hit some early success. Within a few years, or at 23 or so, 24 years old, I became a vice president. And I went on to, at a young age, around maybe 25 or 26, start my own group within UBS. We were pretty different than a lot of the other folks that were kind of in my role at that time. I pursued getting a CFA, which is pretty different for, kind of a financial advisor. Most of that happens really on the buy side or, money management side, but, pursued the CFA and, added to my credentials and, slowly kind of climb the curve of, the learning the industry and garnering kind of bigger and bigger relationships. Around 2004, I met a gentleman through a referral through another client that had just sold his company for $150 million. In those days, I was managing clients in the kind of $1 to $10 million range. So it was a pretty foreign subset of clients for me, but I jumped at the opportunity to work with this gentleman. As luck would have it, it turned out that another advisor in my office had actually cold called this gentleman about a week before I was introduced to him. And nonetheless, I went down to see him from Boston. He was based in New Jersey. And, he asked me what I thought he should be investing in. And I actually told him I had no idea. I think he needed to really think about building a team first and putting a plan together. And I said, I want to do that for you. And, because this other advisor had met him before me, my managing director actually called me into the office after I got back to Boston and said, listen, I want you to split this relationship. And I said, not for me. I think the margin's going to be too skinny to split. I feel like I'm going to do all the work, but, good luck, have at it. I wish you guys the best of luck in trying to capture the relationship. And at that time, I went to my twin brother and I said, Wes, we should leave UBS. I said, there's got to be more people out there in the world like this that have big issues, big issues on and above what goes on inside a brokerage account. And it took some convincing, but after about a year and a half, I convinced my brother that we needed to leave. And we chartered a plan to launch our own advisory firm and, put that plan together kind of early days 2006. And then subsequently resigned from UBS in June 2006. I was sued by UBS. It was the first time in my life that I had ever been, sued or pursued legally, and learned a bit about that, and pretty quickly settled with them, and was kind of off to the races. It was my brother and I, a couple of interns that were working for free, an assistant, and a couple thousand square feet of office space atop one of the big buildings in Boston that we could barely afford. But, I cashed in my 401k, which I wouldn't normally advise folks to think about doing. But I cashed in my 401k, and Wes and I were able to borrow some money from some friends with our own savings to get the business off the ground. Shortly thereafter, once I settled my lawsuit with UBS, I called that gentleman up that I had met a couple of years before and said, hey, remember me? And he said, yes, where'd you go? I told him the story of some internal politics, and I said, what did you end up doing? He said, well, I split the money across 4 or 5 different brokers. He said, I can't track it. Everybody's giving me conflicting advice. I really need somebody to help me oversee the big picture. And so my brother and I went down to see him in New Jersey. And, inside of a couple of hour meeting, he signed up with us. And that was our first $100+ million relationship. And, it was a lot of learning, 17 years ago, this industry of, working with the ultra high net worth and developing this kind of family office model was very new. This was just kind of the earlier days of this large proliferation of wealth that we've seen really over the last 15 or 20 years. And so, they're just, 25 years ago, to have a $100 million relationship in Boston, there was only a few folks in Boston with that kind of net worth. I think today, there's many families that have north of $100 million, not just in Boston, but around the US and around the world. And, so there's been this just big proliferation of wealth globally. And families like this have, institutional type complexities. We often call them internally individuals because they have these, institutional type complexities while they're still being, individuals, and at least in the US, paying US taxes. So, really the last 17 years, starting with that one significant family, we built the business really brick by brick, client by client, to where we are today, overseeing little shy of about 8 billion for about 40 something families.
Yeah, wow, that's such an awesome story. Did you, as an entrepreneur, did you have a certain light bulb moment or burning passion to say, hey, I want to solve this certain problem, or I want to deal with this certain, clientele, and so I have to, break free from UBS in order to do that?
I noticed it as I became kind of senior at UBS, running my own group. I noticed that my challenge and competition was not the other brokerage firms. It was not the Goldmans and Morgan Stanleys and Merrills. I'm sure they were at the table, but I felt like we were differentiated enough to compete against those types of offerings. I continued to feel that the competition was the folks that were truly independent, that were not trying to hawk product to their clients. It was kind of, product of the day that was being pushed down by the sales managers. And I also noticed internally, it was the fee structure issues were just very confusing for clients. And I said, in and around 2004, when I had met this large individual, I said, geez, there's got to be a better way to do this. And so I spent about a year and a half meeting with other firms, thinking about, should I open somebody else's firm in Boston? Should I franchise? Should I, figure that out? And pretty quickly, I realized that, again, this was early days of this family office concept. I said, I can do this myself. I'll figure it out myself. I'm willing to take the risk on myself. Always, my brother and I have always had, very kind of an entrepreneurial spirit. And, probably because of our upbringing where we never really had a safety net with, wealthy parents who were raised really by a single parent, a mom, that taught us the value of kind of hard work. And I never really considered like failure an option in my life. It was always, I knew I would just keep figuring things out. And sure, you have little failures along the way in life, and that's kind of how you learn. But you just got to pick yourself up and kind of keep going and kind of learn from that mistake and say, geez, I won't do that again, or I won't do it that way again. And, I think, all of that is really in the ethos of our firm today. Any company is really, the genesis of kind of the founders, and I think that's very true at TwinFocus, this kind of hustle mentality. And frankly, our client base reflects that, because, I say all the time that people do business with people they like, and people do business with people like themselves. And, when you look at a lot of our clients at TwinFocus, they're folks that are, in many respects, just like my brother and I.
Yeah, no, 100%, Paul. So can you tell us also about, your journey into the investment world? Because I know for me, I was the same thing, right? I was raised in middle-class family in Connecticut. Once I got into the working world, all I was told that the only option was to invest in Wall Street, stocks, bonds, mutual funds, right? And that was really the option until I really started studying the 1%. Right. And how they're truly building wealth. How are they allocating capital? And that's when I began to discover, other asset classes like, real estate, private equity, alternatives, right? And how to then really create, a solid portfolio. And I know that you guys focus on real estate and private equity in addition to equities. So can you tell the audience a little bit more about, your journey and how you view the different asset classes?
Sure. Yeah, I mean, listen, we learn over time. And as much as I would love to tell you that I started my career working with $100 million plus families, it's just not the case. My first relationship was the local liquor store owner that, who bought $20,000 of stocks from me, and I got a commission on it. So, but, slowly over time, you kind of upgrade your relationships and your client relationships over time. And, you learn based on what their needs are and trying to offer a differentiated offering and services and products. I learned over time as a function of, what I needed to do. On the real estate side, we were investing in direct real estate opportunities on behalf of clients for the last decade or so, but not really formally. We were kind of co-investing until 2018, when the Trump administration brought this qualified opportunity zone program to the forefront. And it was really an ideally suited program for many of the families we work with. And so we formalized our efforts around investing in real estate. On the general alternative side, for sure, I understood alternatives, getting a CFA and, investing in those types of products as a broker, as a financial advisor while I was at UBS. But it wasn't really until I started my own firm that I needed to formalize our research efforts around, identifying those types of managers and being able to diligence those managers. And as you know, that opportunity set is constantly shifting. When you look 20 years ago, long short equity investing was very substantial. And today it's become harder to differentiate as a long short investor. And frankly, from an after tax perspective for US taxable investors, it's really hard to make sense of long short returns, even if you're delivering, north of 10% or mid-teen returns, after taxes, because of the way the tax profile works today, where you basically don't get to deduct the fees you pay. You actually end up, for most investors, you end up receiving a net return but paying a tax on a gross return, which is a killer. So it was really out of necessity, learning those various asset classes, and it's interesting when you look at the CFA curriculum, how the CFA curriculum changes over time based on what the current opportunity sets are. Maybe this is reserved for a little bit later in our conversation, but today with the rise in interest rates, there's a significant opportunity in credit. There's different managers playing different areas of the credit world and the spectrum of credit. whether it's real estate credit or corporate credit. But it looks like, especially as the Fed is indicating kind of higher for longer, there's going to be some stress in the system, and companies that finance their businesses or financed assets in a much lower interest rate environment, decades ago, or 15, 20, or even 10 years ago, are now facing this day of reckoning where they're going to have to finance assets at higher rates. And, some assets may not make sense to finance at higher rates. So, there's going to be a lot of interesting opportunities out there and probably some pain for some folks.
Yeah, agree. So have you formulated a particular wealth strategy that you guys have, or an investment thesis, or current mandates that you pretty much, operate with for the families that you're managing?
Yeah, so we largely split our allocations in kind of three buckets. Obviously, it's going to shift from client to client, and clients that have just come into wealth and are starting today with a pile of cash is very different than a legacy portfolio that you've been investing for a decade plus. But largely, we look at the world in terms of kind of equity, general equity exposure, cash, fixed income, kind of an area where you're looking to kind of provide liquidity and not take a lot of risk. And then last, this kind of alternative bucket, which is very wide encompassing bucket. On the equity side, we try to keep it simple. We try not to overthink it. There's too many other things that can go wrong in the investing world and running family offices. So we use a lot of tax managed products. We are able to harvest losses, regularly, and you maintain some type of cheap exposure to beta. We use a lot of ETF type products, low cost mutual funds where we're looking to get some kind of satellite positions within equities. But we just don't overthink it, and we rebalance those allocations on a regular basis. On the fixed income side, obviously the world has shifted there, and folks were, you had to reach for yield, the last 10 years. Well, that's all changed in the last 18 months. And I mean, even as of today, you've got I think the 10-year is topping 3.5, and the 30 years looks like it's, going north of 4, or it is north of 4 today. Very different world, right? I mean, historically, there was no cost to investing in riskier assets because you were getting no return on your cash. Today, there's a big opportunity cost. You could sit in short-term treasuries and make 5 or 6%, which is interesting. I'm not sure how long that short-term trade lasts. Again, the Fed seems to be indicating higher for longer, so maybe it's here longer than most folks think. But I think now is a time to think about kind of broadening out or kind of reaching out in terms of duration. I think it's pretty interesting to be able to lock in almost 4% risk-free on 10 years. You were trying to get that in real estate, a few years ago. You were buying 4-cap real estate. Today you can get that in risk-free treasuries. And then this last bucket is alternatives, and we think of that as a bit more tactical in terms of looking at kind of what's working today. We're big believers, as I think most allocators of capital are, in terms of diversification. As they say, diversification is the only free lunch. I think one of the advantages of working with ultra high net worth families is the ability to take really long-term views on things, and to make long-term bets, where you don't necessarily need capital tomorrow to meet living expenses. You're budgeting for those living expenses in other areas. And so, today, as mentioned, I think, distressed credit is pretty interesting. Commodities are pretty interesting as well. And we've gained exposure to commodities in all different types of ways, from liquid to illiquid to trading managers and such. And then, of course, real estate. We believe in the benefits of real estate, especially for U.S. taxable investors, where you're able to ostensibly lock in a yield that has some type of inflation protection, right? That's with hopes is going to increase as rents increase over time. But that world has been turned upside down with the current state of interest rates, and it's probably going to take some time for the ship to be righted there, and for some opportunities to emerge that are more evident. Today you kind of have to take some risk on some of the hairier stuff, also with the pandemic and with shifts in kind of where folks are living and where they've migrated to, it's also changed the game. In terms of, opportunities in multifamily and industrial and so on.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
And so for your clients, do you actually, have some type of return profile, like an average kind of return profile that you say, you're yielding maybe an average, IRR or something like that, or rate of return across all of these assets? Or are you more talking about basically, wealth preservation strategies, risk mitigation, in addition to, capital appreciation?
The answer is all the above. I think, as the old saying goes, like if you've seen one family office, you've seen one family office. As mentioned, it's we look to diversify across these asset classes. But I think the other thing to keep in mind, when you're dealing with family offices, despite the fact that you've got the ability to really think long term and make long term bets, you really need to manage liquidity. And liquidity profiles are different from family to family, and as a result, portfolios look different. Certainly over time, there is some continuity across our portfolios because we're pursuing similar trades, similar themes. But, as I said, some clients have legacy positions, so it wouldn't necessarily make sense of doubling up exposures or telling clients to sell one type of exposure that they may come into our relationship with if it doesn't make tax sense. And, the beauty of the family office model, at least our model, is that we can think really objectively and independently. And, from a kind of an incentive standpoint, we're paid on the broader relationship. We're not paid based on the investments that we're making necessarily. And so we're paid just as much to tell our client, no, don't make this investment, or keep an investment you may have had before our relationship, as we are yes. And so, we don't have any kind of perverse incentive to push them into any specific sector, product, fund, or whatever.
Yeah, that's a great model because, frankly, the majority of, typical advisors out there just collecting that assets under management fee and not really having mutually aligned interests with investors, I think is not the way to go, right? We want to be advocates and real fiduciaries, right, to the clients so they can objectively make the right decisions. So tell us, Paul, a little bit about, so you mentioned extreme tax planning. It's one of my favorite topics. I never thought I'd be so excited about talking about taxes, but over the years, I've figured, the more taxes you make, definitely tried to determine, tax mitigation strategies, and having exited a business myself, and having, some significant, mitigation to go there. Are there any typical strategies that you guys are advising clients on that you can share with the audience?
Sure. In building the kind of foundation for a complete kind of wealth management solution, family office or otherwise, I often say that it's analogous to kind of cooking. I love to cook, and you don't just show up in the kitchen and start throwing stuff on the grill. There's a lot that goes into cooking before you actually do the cooking, right? I mean, it starts at the grocery store, right? And you're thinking through how many guests you have and who eats what and any restrictions that may occur. And analogous to cooking, again, it starts in the grocery store. You've got to think about who you're feeding, if there are any preferences, any restrictions. You've got to think through, various types of ingredients because you're trying to offer a diversification. From the grocery store, it goes into the house, and it's all about the prep work before things go on the grill or on the skillet. Maybe the fun part is on the grill. The fun part is eating the cooking. But it's the same thing with wealth management. I say to folks that come into, a windfall of cash that, the last thing that you should be thinking about initially is how to invest the money. Like that's kind of the easy part. I don't want to diminish the fact that investing is not completely easy, but it's a little bit more formulaic. The harder part is really planning around the wealth and thinking through what are your longer term objectives, ensuring that you have suitable estate planning documents, if you were to get hit by the proverbial Ferrari or bus, and how those assets would flow over time. And so when new families come to TwinFocus, we spend a lot of time initially on setting up the estate infrastructure and ensuring that estate infrastructure is consistent with our clients' goals and objectives. And a lot of that is you're thinking through tax planning, efficient transfer of wealth to next generation, charitable planning, around, charitable intentions. And then, only then, once you've got that infrastructure established, those various buckets that will, receive piles of cash over time, can you really think about investing? Because, undoubtedly those various buckets in your life, whether it's charitable vehicles or trusts for kids, they're probably going to have very different risk profiles and liquidity profiles, right? Because you've got different time horizons and different beneficiaries in mind. And, and then you can think about, how you're going to invest the capital, but you've got to really kind of lay the groundwork. You've got to understand the tax profile. In terms of tax strategies, for sure, us and, most of the, high net worth world is thinking through how you efficiently pass down wealth to future generations. It was much easier in a lower interest rate world. There's a lot of techniques that really rely on interest rates being low, because effectively what matriarch and patriarch look to do is effectively kind of loan the money in certain ways to future generations and then receive back an interest payment, and then hopefully that future generation is able to make the spread tax free, estate tax free. So on one hand, on the investment side, perhaps you benefit from higher rates because you're able to invest in fixed income and, assets hopefully yielding higher returns. But on the estate planning side, there's a higher cost to doing so. And so some of these, the GRATs and CLATs and, these types of vehicles are not as efficacious in a higher interest rate world. That said, there's still lots of interesting estate planning techniques that you can use to kind of push assets to future generations and help mitigate, taxes. I mentioned earlier in our conversation the Qualified Opportunity Zone program that has come into effect really over the last 5 or 6 years, brought on initially by the Trump administration. It really received bipartisan support. And essentially, the program allows investors to take gains, capital gains that are generated in all sorts of ways, from selling your Apple stock or selling your widget manufacturer, or even capital gains that you receive on a K1 from investing in a hedge fund or private equity fund. You're able to take those gains, roll them into investments, not pay a tax on that initial capital gain until 2026. And then there's all sorts of tax benefits on the investments that you make. And so if you hold these investments for north of 10 years, you receive, you actually receive the benefit of having to pay no tax on your gain on your gain after 10 years. So we've used that quite a bit for our families that have had recent windfalls from selling businesses or certain types of assets, as well as many of our clients are actual professional money managers, hedge fund managers, private equity managers, and receive their annual paycheck or their annual income via K1, via gains. So it's, that's been really kind of a tax nirvana over the last five years. And it's been great for our country, and it's been great for our communities that have been able to kind of foster economic development and, housing and infrastructure needs in areas that have needed the most. So.
Yeah, that's exactly what the tax code is, right? It's 6,000 pages of really a series of incentives, right, for business owners and investors who can understand it and then really put it to work. And, sadly, there's not enough good CPA firms out there that are really providing the right, advice to help clients with that. But such a key part of really, preserving and growing wealth. If you're high net worth, ultra high net worth, right, the taxes are everything. And especially the way the government is spending money, That's probably the only one thing I'm certain of in the future is that taxes will continue to go up. So that tax planning is so key. And as you point out, going down to, G2, G3, G4, right? And really having that long-term view, I think is critical to success.
Dave, even, you're seeing this significant exodus out of high tax states in America. As folks leaving Massachusetts, leaving Connecticut.
I live in one.
Yeah, leaving New York, leaving California, where, Massachusetts, for example, at the beginning of this year, recently instituted this millionaire's tax. So you end up paying an extra 4% on all income over $1 million. And income is, characterized by any kind of, gain that you may have had if you sold a business or whatever. And so, Florida, for example, Texas, Tennessee, these states have been huge beneficiaries where folks, back to our conversation around real estate, folks are leaving these high tax jurisdictions and moving to places like Florida, where they don't have significant estate taxes. They don't have significant income taxes. So, those states have been beneficiaries. And recently, a client, anecdotally, that actually moved from Boston down to Florida, they told me they were waiting in line at the RMV. When they got up to the RMV window, the woman said, what is it with Massachusetts? You're the 24th person today I've seen, relocating from Massachusetts and needing to get a Florida license. So.
Yeah, I've got a friend in Maryland who actually had an $80 million exit, and he was able to purchase a $20 million home in Florida and still have money left over versus had he stayed as a resident in Maryland, paying the state taxes there.
Yeah.
Right. So he was able to put that money to work, for him and do some of that, geographic arbitrage. So another key strategy. And, I appreciate you sharing the insights because I think, everyone is trying to get educated, right? We're trying to learn, how are the new tax laws changing? How does that impact our wealth long term? And as you so well pointed out earlier, Paul, like this all should be designed, around your long-term goals, your vision. Does the family have this vision? And really, how can you align your portfolio to do that? So, you're really living that ideal wealth, that life that you actually set out to create in the first place.
Yeah, Dave, thinking about, charting a strategy for, folks that come into money or have funds and are thinking through how best to allocate, and of course it sounds like I'm talking my own book here, but I can't stress enough that you need to hire good advisors. Analogous to getting sick, and you're not going to go to medical school if you get sick, right? You're going to go and find a great doctor and somebody you trust, somebody that you think knows what they're doing, but somebody you trust. And it's the same is true with a wealth advisor or a tax advisor or a legal advisor. Absolutely, you should be educated on the issues, but you're probably not going to go get a law degree or get a CPA in the time that it's going to take for you to kind of come up the curve and make some good decisions. And so it's really about hiring some good advisors that are around the table and can help you think through really all of the issues. Because many of these issues are just, they're multifaceted. It's why firms like mine exist, because we're able to help our clients think 360, and solve for these blind spots, where it's not just legal, not just tax, not just investment, but it's really all of these issues at once.
Yeah, it's the upstream, the downstream effect, right, of making one chess move. How's that going to impact something else? And having that visibility is key. In my book, The Holistic Wealth Strategy, we talked about that as basically building your own dream team, right? And it's so hard to find great advice, especially when you're talking about, this whole world of, alternative wealth strategy, wealth building, right? That's beyond, your typical advice that's kind of coming out of Wall Street. Because like you say, you need to look at things holistically. It includes lifestyle, it includes health, right? It includes tax, right? All of these different components. But when you get it right, and it's such a great analogy around cooking, you get all of these right ingredients together, the outcome, can be just, really
for sure.
elegant.
Yeah, for sure. Yeah, it's hiring the right advisors and then going slow, You spent your whole life trying to, earn these funds, or, build a business, and you have a big exit. There's no rush. Of course, it's easier to say today in 2023 where you can get 5% in sitting in a bank account versus a few years ago where you felt like the money was burning a hole in your pocket. But it's the other thing that I tell clients all the time is that, when you're high net worth, ultra high net worth, you should not be trying to optimize to a benchmark. The S&P or whatever. I mean, it has no relevance to your life, right? You should be optimizing to sleeping at night, right? And ensuring that you can sustain the lifestyle that you want. And you can't reach for return. Returns are really a function of what the markets give you. You really need to just kind of manage risk and manage liquidity is really what it comes down to. So, and that's easier said than done, but that's really the goal.
Yeah, well said. And it's, I think it's just so challenging in today's world, right? Because it's so reactionary, right? And if you're running a business, you're working at a high stress job, right? It's hard to really carve out that time to determine what is it that you really want to have in life, right? One of the exercises that, we help clients with is, talking about, build 100, your 100 list of things that you want to either be, do, or have, right? And try to get some clarity on that, because it can really be, your guiding compass, right? In terms of how you achieve these things. And like you say, once you really kind of hit a certain threshold of wealth, making more money isn't necessarily going to change your life, right? So what are those levers that actually can drive towards, those things that are really meaningful to you and important to you? So, Paul, if you could give just one piece of advice to our listeners about how they could accelerate their wealth, what would it be?
Ooh, that's a good one. Maybe because I'm always thinking about the downside for my families, and I kind of say I let the upside, take care of itself. I tell folks all the time, when they're looking at investment opportunities, number one, don't fall in love with any investment. It doesn't love you back, so don't fall in love with any investment. And number two, everything in life takes more money and more time than we think. And you need to think about that when you're allocating capital, especially to earlier stage opportunities. You think, oh, I'm getting in at an amazing valuation here. I should go all in. And the truth is, everything's going to take more money and more time than you think. So there's going to be another bite of the apple, a chance for another bite of the apple. And so I think it's really about being kind of measured and ensuring that any of these investments you make, especially once you've made it, quote unquote, made it, that it's not going to materially impact your life, negative or positive. You don't want the investment to be so small that it doesn't move the needle, but you also don't want it to be so large that you're going to have to think about going back to work.
Yeah, well said. Paul, really appreciate you coming on the show today and sharing your wisdom and sage advice with the audience. If people want to learn more about you or TwinFocus, what's the best place they can connect?
You can go right to our newly launched website, just www.twinfocus.com. I think you'll find it pretty informative, and there's a contact button there if you want to get in touch with us. So really appreciate that, Dave.